Yup. Hello, what is up everyone? Jin Hao here, position trader, investor and coach. So in this video, I'm going to share with you how you can start investing in the stock market with just $1,000 of capital. Now, of course, if you have less than 1,000 or you have slightly more than 1,000, it's going to be fine. I'm going to walk you through step by step how you can actually get started investing in the stock market. So first of all, if you like this type of content, do not forget to give me a thumbs up. That would be very great. It will be great for the algorithm and for the overall growth of this channel. And also, if you want to know more about personal finance and investing and topics of this nature, do hit the subscribe button and turn on the notification bell. So with that get out of the way, let's get started. Now, the first thing that we need to discuss is actually why we should invest or why you should start investing if you haven't already. Now, the primary reason is always because of inflation. As the Fed prints more and more paper currencies, there are more paper currency that are chasing after the same goods in the entire economy, and that creates inflation. So meaning that the value of our dollar is depreciating every single day. Instead of working hard and hoping that our parents would catch up the inflation, there is actually a smarter way to get things done, which is to let our hard-earned money works even harder for us, and that's when investing comes into play. Another reason why we should start investing right now, if you haven't already, is of course the first one is because of inflation, the second is of course for the potential profit, and the third one to me is because investing is never an easy process. It is not a get rich quick kind of things. So even when your capital is low, like for example even $500 or $1,000, to me it is building up a habit, accumulating knowledge and experience while we are growing our wealth, when we are growing our portfolio. Because like it or not, if you cannot invest $1,000 well, how are you going to invest 10,000, 100,000 or $500,000, $1 million well? So it is all about accumulating your knowledge and experience together with your wealth being accumulated along this journey. So understand that this is a journey and it is never a get rich quick kind of things. We're gonna put the effort, we're gonna be committed in learning and also sticking with our wealth accumulation plan. Now let's talk about why we should be looking into the stock market. In this era, there are a lot of things out there to be invested, like stocks, bonds, mutual funds, cryptocurrencies, real estates, and the list just goes on and on. Now, to me, stock market is a great starting point, is because compared to things like cryptocurrencies, the stock market is less volatile and is regulated. And compared to real estate, okay, stocks are easier to be transacted, meaning that it is easier to be bought and sold, and it requires way less capital to get started. You can start with $1,000, $2,000, or even $500. Now, with $500 or $1,000, it is quite tough to be to invest in the real estate. And I also look at the world richest people out there, like Jeff Bezos, Mark Zuckerberg, Bill Gates, and so on. Each of them has at least one listed company that represents them, and they're actually building their wealth. The rich are actually building their wealth through their companies which are listed, and I don't see why we shouldn't, because all these people's, their wealth, they're out there, they are billionaires because one of the reasons is because they have their companies that are listed, and the company just grows in value every single year. And this is just a crash course. If you do not know what is a stock is basically an ownership of a company. So when we are buying into a company's stock, we are actually investing into the company. We have a very small portion of ownership of that particular company. For example, if I buy into Tesla stock, meaning that I will have one very tiny little portion of Tesla's company, meaning that I own that company. So if the rich, again, if the rich are building their wealth through their companies that are listed, it is actually one of the easiest way for us to ride the trend. What trend is this? The trend of them building their wealth, building their growing their company. And stocks are being listed in stock exchanges. So there are a lot of stock exchanges in the world. In the US, the primary one would be the Nasdaq and the New York Stock Exchange. And many countries have their own individual stock exchanges as well. You can treat stock exchange like a supermarket of stocks whereby stocks are being listed, meaning that they are being put on the shelf for us to transact. To buy and sell stocks, this has to be done through what we call brokers. Now, there are a lot of brokers out there in the market, and basically they are providing the similar services, which is allowing us to buy and sell stocks through them, and they help us to send to the exchange. What are the differences between the brokers out there? Could be like the commission that they're offering. Now, a lot of brokers out there, they are offering free commissions already, meaning that there is no broker fee when you buy and sell stocks, and also the user friendliness of the platforms, and also some of the extra value added services like webinars, trainings, okay, and also live support that the different brokers offer. Now, to me, I will stick with brokers that are more reputable, meaning that they are out there in the business for a couple of decades already, and also they are big companies. So to cut short your time on this, I'll just share with you the brokers that I use. I use Interactive Brokers, TD Ameritrade, and also First Trade. So you can go and do some due diligence on these three brokers and then choose the one that you think would be the best for you. And also do not forget to actually sign up for the broker account and try out the platform first and see which platforms is more user friendly, at least for you. Now let's talk about the differences between investing and trading. Now, investing basically it means buy and hold strategy. The intention is always to stay invested until the reasons for you to invest or stay invested in that company is no longer intact. Now, on the other hand, trading refers to buying a company's stock with the expectation of selling them at a higher price in the near future, regardless of the time frame. So this is what we call trading. Capital gain is the only thing that traders actually care. As far as trading is concerned, there is one common misconception that a lot of people have on trading, which is trading must be short term. Now, this is actually not true. Trading does not equal to speculation. Now, of course, speculation is a type of trading. Now, as I mentioned just now, trading refers to buying a company's stock with the expectation of selling the stock at a higher price in the future. So if your intention is to make that capital gain in the near future, regardless of the time frame, you are actually trading. Now, of course, there are long-term traders, position traders, trend followers, mid-term, short-term to day traders, and also speculators and scalpers. Now, the more short-term you go, the more time you need to spend in monitoring the market as well as your position. Now, personally, I have no intention to do this because it becomes less passive, and as you go short-term, it becomes a job to me. And again, like what I mentioned just now, my intention is to let my hard-earned money works harder for me. Now, if it becomes a job, meaning that I'm still working very hard on the portfolio, and that is actually not my initial intention. I want my investments or even my trades to go as passive as they can. Now, let's talk about the two main school of thoughts when it comes to investing or trading in the stock market. The first school of thought is actually called fundamental analysis, and the second one is technical analysis. So, in short, technical analysis refers to analyzing using one thing called charts. And fundamental analysis, the direction is always to find one thing called value. Now let's discuss about the two school of thoughts when it comes to investing and trading in the stock market. Now the first school of thought is known as fundamental analysis, and the second school of thought is known as technical analysis. Now, as far as technical analysis is concerned, it is actually a type of analysis that is being done by reading and analyzing the charts. So technical analysis will basically analyze the trends, the movement, and make some kinds of like predictions based on the price actions or the movement of the price alone. Now, whereas fundamental analysis, the direction of the analysis is always finding the value of the companies by using either quantitative or qualitative analysis. So quantitative analysis refers to things like ratios and figures that can be quantified, while qualitative analysis refers to like studying the industry, studying the company's future prospect, how's the management team, and things that cannot be quantified. So this is the value of the company. And then from a fundamental standpoint, the market is always going overvalue and undervalue and overvalue and undervalue and overvalue and undervalue. So the attempt that a lot of fundamental investors are doing is actually trying to buy when the stock is undervalued and then sell when the stock is overvalued and repeat the process to buy here and sell here. Now, this seems okay if it is at a perfect scenario. Now, however, in reality, there is actually a problem. So the price can actually go overvalued and then go very overvalued before it comes down. And then when it is undervalued, it can go even more undervalued before it starts moving up. So in reality, things are not that perfect. And that's why the challenge that a lot of fundamental investors face is actually we can never tell how overvalued is overvalued and how undervalued is undervalued. And this is why in general, okay, I don't really care about these kind of overvalued and undervalued things that much. Now, although we can make educated decisions with a lot of quantitative analysis like all the ratios and based on the financial statements and things of that nature, but there is still no great guidelines, at least those that I know, there is no great guidelines that can tell us how overvalued is overvalued and how undervalued is actually undervalued. Because a lot of time when we buy into something that we think is undervalued enough, and then the stock basically go lower, and that's how a lot of people got stuck. So if the investors have bias towards that company, that can make things even worse. So as far as investing is concerned, what I primarily focus is actually finding companies or sectors that will go up in value over the long run. So the questions that I will ask myself is actually, what companies or whether or not that sector or industry will change or revolutionize the way we live in the next 5 to 10 years? Because if the company or the sector has the power to actually influence the way we live or revolutionize the way we live in the next 5 to 10 or even longer in the next few decades, for example, then over the long run, what is guaranteed is actually the value of the company will go up. So no matter how the price move, how overvalued or undervalued it goes, over a long period of time, over a long run, let's say 5 to 10 years or even longer, your investment will actually make money for sure. On a side note, you can have multiple portfolios. For example, one for investing and one for trading. Now, this is basically what I practice myself. So each portfolio is going to have different goals and being managed by different strategies. So for me, my trading portfolio is being managed with trend following method, whereas as far as the investment portfolio is concerned, I invest into companies that are within the sectors or the companies have the power to change the way we live or revolutionize the way we live in the next decade, as well as some high quality ETFs. Now, apart from investing in individual companies' stock, you can also invest in the basket of stocks known as ETF or exchange traded fund. Now, in my last video, I mentioned about 4 ETFs that are great starting point for beginner investors. Now, if you're interested in finding out that 4 ETFs, you can click the pop-up banner at the top right corner here to find out more about those ETFs after watching this video, of course. All right, so let's continue. There are 3 reasons why you want to look into ETF investing. So the first reason is, of course, diversification. So you can actually get your limited capital, which is like $500 or $1,000 or $2,000, to be exposed to a basket of stocks instead of an individual stock. Now, with $1,000, you can actually invest into, you can actually buy 1 unit of S&P 500 index ETF like the SPY, and also at least 1 unit of the Nasdaq 100 ETF called the QQQ, and you will still have money left. Whereas if you were to buy individual stocks with just $1,000, you probably cannot diversify much. You can only buy like maybe 1 Apple stocks, 1 Adobe stock, and 1 Microsoft stocks. And you can't even buy into stocks like Google or Amazon that are priced at like $2,000 over dollar. So, and all these great companies like Amazon, Facebook, Tesla, they're actually included in this basket of shares, especially like the S&P 500 index ETF, the SPY, or the Nasdaq 100 index QQQ. So with limited capital, you can let your money to expose to all these great companies all together. The second reason why you want to look into ETF investing is because great ETFs are designed to go up in long run. Now, I also explained in the previous video, so make sure you watch the video after this. And the primary reason is because the bad performers within the ETF will always be replaced with better performers. So you always get to invest in the best companies out there in the market, especially if we talk about the S&P 500 index ETF or the Nasdaq 100 ETF. The third reason why you want to look into ETF investing is because a lot of the ETFs out there that track certain indexes, they are market cap weighted. So what does market cap weighted means? It means that the higher your market cap, the more important you are, as in the heavier you would weight in that index. So you do not need to worry about stock selection, which can be very tricky, especially when you're just getting started, because the best companies out there will always carry higher weightage, which means more of your money will be exposed to the better companies which have higher market cap out there, just like Apple, Microsoft, Google, Amazon, Tesla, and so on, depending on what ETFs you are investing in. Now let's talk about how you can buy your first stock or ETF through a broker. So I'm using the mobile version of the TD Ameritrade platforms known as thinkorswim. Now you might be using other brokers, so what you need to do is actually go through the tutorial or at least the guideline on how you can key in the orders. So platforms UI might be different. What I want to cover is actually some of the terms that you need to know. Now, first thing, of course, you always want to search for the ETF or stocks that you want to buy. In this case, is the SPY or the S&P 500 index ETF. And then we're going to go into the order panel. So make sure it is buy and then key in the quantity that you would like to buy. Now, the next thing you need to look at, which is very important, is the type of order. Now, if the type of order is market, it means that if the market is open right now, you key in this market order, the system will automatically match your order, meaning that in this case, it will buy 1 unit of SPY for you at the current market price. So the current market price can be 465.51 right now, but of course, right now the market is closed. When the market is open, the price can move up and down. So when you key in a market order, remember that it means I want to buy right now. Okay, I want to buy right now. So price is not what you can determine right over here, because this market order will have a guaranteed execution at the current market price. So you cannot set the price. It would match directly at the current market price. So if the market is moving very fast, you might not be getting the unit that you want to buy at the price that you would like to. So for investment purposes, I like to use limit order. So limit order, you can think in this way. I want to buy cheaper. Okay, I want to buy cheaper. I want to have a better bargain. So right now, the S&P 500 index, the index ETF, in this case, the SPY, is trading at 465.51. I want to buy at 465, for instance. Okay, so I can change the price to 465, and then it will queue my order at 465. So should the market goes down and hit 465, then my order will be matched at 465 or lower. So meaning that the maximum price that I'm willing to pay in this case is 465. You're not going to match at any price higher than the limit price. So meaning that in this case, the price is guaranteed to be at 465 or lower, but the execution is not guaranteed. The price has to go down in order for this order to match. Now, the next thing that you want to look at is actually, you look at the word called day, okay? And you hover around, you will see GTC. So GTC means good till cancel. Okay, good till cancel. Now, different platform, they may be labeled differently, but GTC is a very common term. Now, good till cancel means this order will stay valid, will be in queue until you cancel it. So meaning that if I were to queue at $465 to buy SPY, if today the order is not matched, it will still be there tomorrow, the day after tomorrow, or next week, until either it is matched or until I cancel the order. Now, if you leave it at day, meaning that the time in force in this case is TIF, the time in force for this order would be on today only. So today, if it is matched, then I will get it at $465 or lower. But if it is not, then the order will expire, meaning that tomorrow I have to re-enter the order. Now, from an investment perspective, I always like to use limit order to get at the bargain price. So, and I will put it at GTC so that I always have my buy order queuing there at the price that I want to, or a maximum price that I am willing to pay. So when you're investing, remember to always look for a bargain. So in this case, I call it a bargain. So limit order is the way to go. Now let's talk about one topic, which is how much you should be investing. Now it is hard to see any single person who jump into the stock market and straight away, right off the bat, they are crushing it and start making a lot of money. So be it you are investing or trading, understand that this journey is a wealth accumulation journey, and it is a process of building up your wealth, accumulating your wealth. So losing is also part of the game. There is no 100% sure win kind of thing. So invest in what you could afford to lose and slowly build out both your confidence and portfolio from there. One great strategy that a lot of people have been using is actually known as dollar cost averaging. So dollar cost averaging basically refers to investing the same amount every single month. Now, for example, if you invest $500 every month, when the prices are high, you're going to buy less units with that $500. And when the prices are low, maybe the market has a recession or there's a crash, with the same $500, you're going to buy more units. So over the long period of time, your cost of accumulating the stock or ETFs is going to be low. Now again, this strategy is one of the most powerful and useful strategies out there for long-term wealth accumulation process without timing the market. So again, understand that investing is not a short-term game. Okay, it is definitely a long-term game. So it is a wealth accumulation process like what I mentioned just now. So what you need to do is actually commit to a plan that you have set. For example, how much you want to invest every month, or if you cannot afford to invest every month, how much you want to invest every quarter. And the next thing that you need to do is actually stick with the plan. So question of the day, how much are you willing to commit in investing every single month? Type in the comments below and share with us. Another thing worth mentioning is actually dividend payouts. When we invest in a company, we actually have a small piece of ownership of that company, which also means we actually are entitled for any future earnings of that particular company. When a company decides to reward their investors, one of the things that they can do is actually to pay out dividends to the shareholders. ETFs will also pay out dividends when the basket of stocks that they are holding are paying out dividends as well. Now, there are a lot to talk about dividends, and there are some misconceptions when it comes to dividend payout. I'm not going to cover those things here, or else you will be very confused. However, there is one thing that I would suggest you and recommend you is to actually reinvest your dividend instead of cashing them out. Now, there are two reasons why I recommend so. Reason number one, depending on which country you are from, you might need to pay some sort of tax if you choose to cash out the dividend. For example, I'm from Malaysia. There is a 30% withholding tax if I choose to cash out any dividend payouts that are being paid by companies listed in the US market. By reinvesting the dividend, the entire dividend payout will be used to repurchase the stock. So I get more units in that way. All right, so final tip for you is this. Always have cash reserve. Now, I believe that you know that the markets have bull and bear market, meaning that the market has cycles. Sometimes they go up and sometimes they go down. Now, when the market is actually performing great, most probably your investments are going to make money, especially if you are in high quality ETFs like the SPY or QQQ. When the market goes down or when we are in a bear market, a lot of people know that it is actually an opportunity to collect stocks and ETFs that are great, or stocks and ETFs that you have conviction with at a cheaper price. However, when we are in the market, there are a lot of people actually complaining about markets going down and people feel bad about it. The primary reason why people feel bad about bear market or when the market is going down, despite knowing that it is actually a great opportunity to collect stocks and ETF at a cheaper price, is because they do not have cash reserve or they do not have enough cash reserve to actually take up the opportunities. So when a person cannot take up the opportunity, they feel bad about the market going down and because they simply cannot do anything. If you are committed to your plan and invest every single month with dollar cost averaging, you will kind of appreciate slow months or bear markets because these are the opportunities whereby you can collect more units of what you want to invest in at cheaper prices. If you have cash reserve, you will be even happier because that would be your golden opportunities to collect even more of the stocks or ETFs that you are investing in. Personally, I only do this on high quality ETF, namely the SPY and QQQ. Now, the reason is very simple. We might have bias when it comes to individual companies because we might understand one industry more than another. So it creates a lot of bias when it comes to analyzing individual companies. And when the market is having a correction or it is in a recession, sometimes some stocks will not get to recover even after the market recover. On the other hand, indexes have no bias. So whichever companies that are performing great would always weight higher within that index, and so goes to your investment. Alright, so that will be all for this video. I hope that this video gives you some clarity on how you can get started investing in the stock market. Now, of course, this video is not everything. There's still a lot of homework that you need to do yourself, especially when it comes to selecting stocks and ETF to invest in. So if you like this type of content, do not forget to subscribe to my channel and hit the notification bell so that you get notified when I post any upcoming video. So with that said, thank you very much for watching and I will see you when I see you. Peace.